Whatever brought you here today, stay with this video for a few minutes. Because there is a strange contradiction at the heart of investing. The market can fall while your financial life remains healthy, and the market can rise while your financial life becomes dangerously fragile. The market does not know what your money feels. It does not know whether a falling portfolio represents money you need next month or capital you will not touch for decades. It does not know whether a loss is destroying your sleep, whether debt is increasing your pressure, or whether your income can comfortably support your investments. The market sees prices and transactions. You experience consequences. This difference explains why two people can look at exactly the same market and experience completely different financial realities. Why does the market ignore your personal financial situation? Because the market is fundamentally a mechanism for continuously repricing expectations about future economic activity, earnings, liquidity, risk, and demand. Your personal anxiety is real, but it is not automatically a market signal. That distinction matters because investors frequently confuse emotional information with financial information. Imagine your investment falls sharply. Your mind immediately asks, should I get out? But the better question is, has something fundamental about my financial plan changed, or has the market simply changed its expectations? Those are completely different questions. If your income remains stable, your emergency savings are adequate, your investment horizon is long, and your obligations have not suddenly increased, a temporary price decline may change your portfolio's value without changing your underlying financial capacity. But if you need that money soon, carry expensive debt, have unstable income, or lack liquidity, the same market decline can become a genuine financial problem. This is why risk is personal even when prices are universal. Modern markets also react to information long before ordinary households experience its consequences. Artificial intelligence, automation, changing energy systems, demographic shifts, scientific discoveries, and productivity improvements can alter expectations about entire industries years before those changes become visible in everyday life. That creates another uncomfortable question. Why can markets appear irrational today and reasonable tomorrow? Because markets are not simply pricing what exists now. They are continuously attempting to price what participants believe may exist later. When expectations change faster than reality, prices can move dramatically even though nothing visible has changed in your personal life. This is one reason headlines can be psychologically dangerous. A headline describes what happened in the market, but your brain instinctively translates it into a prediction about your future. Behavioral finance calls attention to how losses can feel disproportionately painful compared with equivalent gains. The result is that investors may make permanent decisions in response to temporary emotional discomfort. But there is an even deeper problem. Your portfolio can become psychologically larger than your actual financial life. If you constantly watch prices, every movement begins to feel like income gained or income lost. Your brain starts treating unrealized fluctuations as immediate events. That can create a feedback loop in which anxiety produces monitoring, monitoring produces emotional reactions, and emotional reactions produce unnecessary decisions. The solution is not to become emotionless. It is to separate what you feel from what the financial system is actually telling you. A falling market may be telling you that expectations have changed. Your personal fear may be telling you that your position is too large, your time horizon is too short, or your financial foundation is too weak. Those are different messages, and confusing them can be expensive. This is where cash flow becomes essential. Suppose two investors hold similar investments. One has predictable income, manageable expenses, adequate liquidity, and no immediate need for the invested capital. The other depends on that capital for near-term expenses. A market decline affects both portfolios similarly, but it does not create the same financial consequence. The price movement is identical. The risk is not. That is why wealth management cannot be reduced to choosing assets. It also involves managing liquidity, income concentration, debt, expenses, skills, health, and time. Your earning ability is itself a financial asset. In a world increasingly shaped by automation and artificial intelligence, lifelong learning becomes a form of risk management. Developing adaptable skills can increase your ability to generate future cash flow when existing economic structures change. Health matters for the same reason. Your ability to work, think, communicate, learn, and make decisions contributes to your financial resilience. A strong portfolio cannot completely compensate for a life whose physical and psychological capacity has deteriorated. Relationships matter too. Financial decisions rarely exist in isolation. Family responsibilities, communication, trust, and shared expectations can determine whether a financial shock becomes manageable or overwhelming. This leads to a more useful definition of financial strength. Financial strength is not the ability to predict every market movement. It is the ability to remain functional when your predictions are wrong. That idea has a powerful parallel in the Bhagavad Gita. Action remains within your responsibility even when the outcome does not. Applied to investing, this means your responsibility is not to command the market. Your responsibility is to understand your objectives, manage risk, maintain discipline, continue learning, and make decisions appropriate to your circumstances. Lord Hanuman represents this principle through a different dimension: strength under purpose. His courage was not recklessness. His discipline was not rigidity. His humility did not weaken his power, it gave his power direction. That distinction is valuable for investors because financial courage does not mean taking unlimited risk. Sometimes courage means refusing to panic. Sometimes it means admitting that a position is inappropriate. Sometimes it means holding patiently. Sometimes it means changing course when evidence demands it. And gratitude changes the relationship with uncertainty. Instead of asking only, why is the market doing this to me? You can ask, what is this environment teaching me about my financial structure, my risk tolerance, and my behavior? That question turns market volatility into information about yourself. The market will continue ignoring what your money feels because it cannot feel it. You can. And that is precisely why you must build a financial system around realities the market cannot see: your cash flow, your obligations, your health, your skills, your relationships, your time horizon, and your emotional behavior. The deepest lesson of stock market engineering is therefore not how to predict every movement. It is learning how to design your financial life so that you do not need the market to behave perfectly for you to remain steady. Let the market price uncertainty. Let your discipline manage it. Let wisdom determine your decisions. And let the courage, humility, devotion, and self-mastery associated with Lord Hanuman remind you that true financial strength is not the absence of fear. It is the ability to act wisely even when fear is present. When you reach that point, the market may continue to ignore what your money feels. But your financial system no longer has to. Jai Hanuman.